The United States Mint just made a move that caught everyone off guard. Within 48 hours, prices doubled across their entire silver catalog. A coin that cost $95 last week now commands $173. The Batman metal jumped from $275 to $400. But here's what nobody's talking about. There was a brief window, a narrow opportunity, when a few informed buyers secured inventory at the old prices, while the institution was effectively giving away silver below spot value. Those who moved fast now hold positions at 50% discounts. But the real question is, why did a sovereign mint, backed by the full faith of the United States government, suddenly need to execute such a dramatic retreat? What pressure forced this decision? And what does it reveal about the physical silver market that paper contracts aren't showing you? Welcome to CashTale, where we decode the economic signals that serious decision makers need to understand. If you've built something in your life, if you understand that wealth requires strategy, not speculation, then this channel speaks your language. Take a moment now. Click that subscribe button, because the insights we share here aren't for passive viewers. They're for people who've earned their position through decades of discipline. And we're curious, where in the world are you watching from today? Drop your location in the comments. Let's see how far this community of strategic thinkers extends across the globe. The United States Mint has executed one of the most dramatic pricing adjustments in its modern operational history. Without advance warning beyond a brief email notification, the institution nearly doubled prices across its entire silver product catalog within a 48-hour window. This development represents far more than a routine cost adjustment. It signals fundamental stress within the physical precious metals distribution system. The pricing revision became apparent when updated figures appeared on the official U.S. Mint website, catching even experienced numismatic investors off guard. A 2023 American Silver Liberty medal, previously priced at $97, now carries a $170 price tag. The Proof American Silver Eagle, formerly available at $95, has been repositioned to $170 thrice. The institutional response was swift and absolute. Within hours of the final pre-revision orders being processed, the entire silver inventory moved to unavailable status. No new orders could be placed. The purchasing window had closed. Those who secured positions during the final hours before the shutdown found themselves holding inventory acquired at what would immediately become 50% discounts to replacement cost. The Thomas Jefferson Presidential Medal provides a particularly stark example. Purchased at $90 during the final ordering window, it now lists at $164 for future availability. The scope of the repricing extends beyond individual coins into complete product sets. The Morgan & Peace Dollar Reverse Proof 2-coin set, previously offered at $215, now commands $375. Silver proof sets have been repositioned to $245. Even standard 1-ounce presidential and military medals have moved from accessible price points to $164 per unit. The mathematical reality is unavoidable. The United States Mint has fundamentally recalibrated its entire silver pricing structure in a single decisive action. What makes this development particularly significant is the institutional context. The United States Mint operates under a self-sustaining mandate. Unlike agencies funded through congressional appropriations, the Mint must generate sufficient revenue to cover production costs, labor, security, distribution infrastructure, and operational overhead. When commodity prices move faster than pricing models can accommodate, the institution faces an operational crisis. The recent silver market volatility, with daily price swings of $3 to $6 becoming normalized, has clearly overwhelmed the Mint-Diz traditional pricing methodology. The timing reveals additional layers of institutional pressure. Several products were sold during a brief window when transit pricing actually fell below spot market values. The Thomas Jefferson medal purchased at $90 was in transit, while silver spot prices exceeded $93. This represents an unsustainable arbitrage situation for any commercial operation, let alone a sovereign mint with fiduciary responsibilities. The institution was effectively subsidizing precious metal acquisition for savvy market participants, a position no self-funding entity can maintain. The product-specific dynamics add further complexity. Morgan and Peace dollars contain less than 1 full ounce of silver, yet now carry pricing equivalent to 1-ounce silver eagles. This suggests the mint is pricing based on production complexity and collector demand rather than strict metal content, a shift that fundamentally alters the value proposition for different buyer segments. Meanwhile, licensed products like the DC Comics Batman series carry compound premiums, stacking licensing fees atop already elevated base costs to reach price points that test even dedicated collector commitment. Director Hollis now oversees an institution facing a fundamental strategic question. How does a sovereign mint maintain collector market participation while protecting operational sustainability during unprecedented commodity volatility? The current pricing structure may represent emergency positioning, buying institutional breathing room while a more sophisticated pricing grid is developed. Gold products have long operated under dynamic pricing models that adjust with market conditions. Silver may be transitioning to a similar framework. The immediate result is clear. The United States Mint has effectively removed itself from the accessible silver market. What was recently a competitive source for both collectors and stackers has become a premium channel serving primarily committed numismatic buyers willing to pay substantial premiums over spot prices. The strategic implications of this shift will reverberate through the broader precious metals market as participants reassess sovereign mint reliability during periods of market stress. The United States Mint operates within a unique paradox that few government institutions face. Established as a bureau of the Department of the Treasury, it carries sovereign responsibilities while functioning under commercial imperatives. Since 1996, the Mint has operated as a self-sustaining entity, required to cover all operational costs through product sales without direct taxpayer funding. This hybrid structure creates vulnerabilities that remain invisible during stable market conditions, but become acutely problematic when commodity prices enter volatile cycles. The operational reality behind silver coin production reveals why static pricing becomes untenable during market turbulence. Each product requires multiple cost inputs beyond raw metal: blank preparation, die creation, and maintenance, striking operations, quality control inspection, packaging materials, specialized storage, secure transportation, customer service infrastructure, and website maintenance. Labor costs remain fixed regardless of metal prices. Security protocols carry constant expense. Distribution networks require sustained investment. When the Mint commits to a published price, it assumes all cost risk between the moment of listing and the completion of delivery, a period that can extend weeks or even months for high-demand products. This exposure becomes critical when examining recent silver market behavior. The metal has exhibited daily price swings of $3 to $6, representing movements of 4 to 7% within single trading sessions. For an institution that must purchase blanks, manage production schedules, and fulfill orders across extended timeframes, such volatility introduces catastrophic margin risk. A coin priced Monday at what appears to be a sustainable premium can become a loss-generating transaction by Friday if spot prices spike during production. The contrast with gold operations illuminates the strategic problem. Gold products at the U.S. Mint have long operated under dynamic pricing grids that automatically adjust to market conditions. When gold moves, product prices move proportionally, maintaining consistent premium structures regardless of absolute price levels. This protects the institution from adverse price movements while maintaining predictable margins. Silver products, however, continued operating under legacy static pricing, a methodology designed for calmer markets that no longer exist. The complexity deepens when examining product-specific economics. Morgan and Peace dollars require specialized dies, intricate striking processes, and carry significant collector appeal, yet contain only 0.858 ounces of silver. Under previous pricing, these sold for $250 per two-coin set, or roughly $107 per coin. With silver spot prices exceeding $90, the Mint was selling products with less than 1 ounce of content for barely more than the raw metal value. Production costs, overhead allocation, and distribution expenses were compressed into margins so thin they approached break-even or worse. The commemorative licensing arrangements introduce additional pressure layers. Products like the Batman High Relief Metal require DC Comics licensing fees that must be paid regardless of market conditions. These fixed obligations stack atop variable metal costs and fixed production expenses, creating compound margin compression during price spikes. When the institution committed to $275 pricing for a 2.5-ounce licensed product, it likely anticipated silver remaining within historical ranges. The subsequent price environment rendered those commitments unsustainable. Perhaps most revealing is what occurred during the final purchasing window, the brief period when informed buyers secured inventory at original prices while silver continued climbing. The Thomas Jefferson metal sold at $90, while silver spot exceeded $93 in transit. The American Silver Liberty metal moved at $97 during similar conditions. The institution was delivering precious metal products below replacement cost for the metal alone, before accounting for any production, overhead, or distribution expenses. This represents operational failure, not strategic pricing. The proof and uncirculated product lines present their own challenges. These require additional quality control, specialized handling, premium packaging, and separate production protocols. Yet previous pricing differentiated these products from bullion by only modest amounts, often just a few dollars. When base metal costs surge, maintaining tiny premium differentials becomes economically irrational. The current repricing attempts to restore meaningful separation between product tiers while protecting margins across all categories. The new director inherits an institution caught between incompatible mandates: serve the collector community with accessible pricing, maintain operational self-sufficiency, preserve product quality standards, and absorb commodity volatility without raising prices that might alienate customers. These objectives cannot coexist during extreme market conditions. The dramatic repricing represents acknowledgement of this reality, an institutional decision to prioritize sustainability over accessibility when forced to choose between them. The United States Mint's pricing disruption did not occur in isolation. It represents one visible symptom of deeper structural tensions developing across the physical precious metals market. While paper silver contracts trade with apparent liquidity on commodities exchanges, the institutions responsible for delivering actual metal into customer hands are signaling constraint through price, delay, and reduced availability. The gap between financial market pricing and physical product accessibility has widened to levels that demand serious analytical attention. Consider the mathematical anomaly that emerged during the final purchase window. Buyers secured American Silver Eagles at $95, while spot prices climbed toward $93, barely covering metal content before accounting for sovereign mint premiums, production complexity, or distribution costs. Experienced market participants recognized this immediately as mispricing rather than generosity. The U.S. Mint was not offering promotional pricing. It was trapped in commitments made under assumptions that no longer matched market reality. This type of dislocation typically precedes significant structural adjustments. The speed of institutional response carries its own information content. Major bureaucratic entities rarely execute dramatic policy reversals within 48-hour windows unless facing acute operational pressure. The abrupt suspension of silver product availability, followed by wholesale repricing, suggests decision-making driven by urgency rather than strategic planning. Institutions do not voluntarily alienate customer bases or disrupt established sales channels without compelling reason. The question becomes, what conditions forced this rapid institutional retreat? Examining parallel developments across sovereign mints globally reveals this is not an isolated American phenomenon. The Royal Canadian Mint has experienced extended delays on silver maple leaf deliveries. The Perth Mint faced controversy over allocated storage programs. The Austrian Mint adjusted premiums on Philharmonic silver coins. Each institution operates under different regulatory frameworks and market structures, yet all are exhibiting similar stress patterns. When multiple independent entities respond to common pressures with comparable actions, it signals systemic issues rather than localized problems. The collector versus stacker divide has become particularly pronounced during this episode. Numismatic buyers traditionally focus on design elements, mintage limits, historical significance, and long-term collectability. These factors justify premiums over metal content because the product carries value beyond its silver weight. Stackers, conversely, prioritize metal accumulation at lowest cost per ounce, viewing coins primarily as bullion in government-certified form. The U.S. Mint's new pricing structure effectively abandons the stacker segment entirely, repositioning all products as premium numismatic offerings. A 1-ounce presidential medal at $164 represents a 77% premium over a $93 spot price, pricing that only committed collectors will accept. This segmentation strategy reveals institutional calculation about where sustainable demand resides. The Mint appears to have concluded that volume sales to price-sensitive stackers at thin margins during volatile markets creates more risk than reward. Better to serve a smaller collector base willing to pay substantial premiums than chase volume that becomes unprofitable when prices move adversely. This represents a fundamental business model shift, from mass market accessibility to specialized premium positioning. The Remind Me status, now displayed across the silver catalog, introduces another layer of strategic ambiguity. Is this simply inventory depletion requiring production catch-up? Or does it represent deliberate supply management while the institution assesses whether new pricing levels will clear the market? The distinction matters significantly. Temporary unavailability suggests eventual normalization. Strategic supply restriction indicates the Mint is testing price sensitivity before committing to production volumes at elevated cost structures. The speculation around dynamic pricing grids for silver products deserves serious consideration. Gold has operated under such systems successfully for years, with prices adjusting automatically as the underlying commodity moves. Implementing comparable methodology for silver would protect the institution from the margin compression that triggered the current crisis. However, it would also eliminate the pricing predictability that collectors value when planning purchases. The trade-off between institutional protection and customer certainty represents a strategic choice with no perfect solution. What remains undeniable is that sovereign mints, entities backed by government authority and operating with institutional credibility, are demonstrating through pricing and availability that physical silver markets are tighter than paper market liquidity suggests. When the institutions responsible for transforming raw metal into finished products begin rationing supply through price, serious market participants should recognize this as a signal worth analyzing rather than dismissing as mere profit-seeking. The U.S. Mint pricing disruption provides a case study in institutional behavior under commodity market stress that extends well beyond numismatic circles. What occurred represents a template for how sovereign entities respond when legacy operating models collide with new market realities. For business strategists, investors, and economic observers, the episode offers actionable intelligence about physical precious metals markets, institutional risk management, and the growing divergence between paper pricing mechanisms and actual product delivery systems. The immediate strategic question facing market participants is whether current premium structures represent temporary dislocation or permanent market repositioning. If the mint's pricing proves unsustainable, if customer demand collapses at $173 for proof Silver Eagles, expect eventual moderation back toward more competitive levels. However, if sales continue despite doubled prices, the institution will have successfully reset market expectations around what constitutes acceptable premiums during volatile periods. Early sales data after products return to availability will provide critical signals about which scenario is unfolding. The segmentation between acquisition channels has never been more pronounced. The U.S. Mint now occupies premium positioning exclusively. Buyers prioritizing cost efficiency must turn to private dealers, international mints, or secondary markets. This creates arbitrage opportunities for sophisticated participants. Those who secured inventory during the final low-price window now hold products trading at substantial premiums to their acquisition cost. Whether these premiums persist depends on broader market direction, but the spread exists currently for those positioned to exploit it. The collector versus stacker framework requires recalibration in light of current dynamics. Traditional numismatic buyers acquire coins for reasons beyond metal content, historical significance, artistic merit, limited mintages, condition rarity. These factors justify premiums because they create value independent of spot prices. The U.S. Mint's new structure forces all buyers into collector methodology, whether they prefer it or not. There is no longer a cheap option for silver acquisition through this channel. This fundamentally alters the value proposition and eliminates the entire buyer segment from the institution's addressable market. The semi-quincentennial products scheduled for a 2026 release present a particularly complex strategic calculation. America's 250th anniversary will generate commemorative issues with genuine historical significance, products that may carry long-term numismatic value beyond their metal content. However, if these items launch at the elevated pricing structures now established, participation will require substantial capital commitment. Serious collectors must decide whether historical importance justifies premium pricing or whether secondary market acquisition after initial enthusiasm fades offers better value positioning. Risk assessment around premium compression scenarios deserves careful attention. If silver spot prices retreat significantly from current levels, products purchased at today's elevated premiums could face substantial book losses. A proof: Silver Eagle acquired at $173 becomes problematic if spot prices fall back toward $70-$75 ranges. The premium component provides some protection. Numismatic value does not disappear with metal price declines, but substantial downside exposure exists for recent buyers at peak pricing. Portfolio construction must account for this risk through position sizing and acquisition timing discipline. The broader institutional credibility implications extend beyond immediate pricing debates. The U.S. Mint operates with sovereign backing and century-spanning reputation for reliability. Abrupt policy changes, even when operationally justified, erode customer trust and create uncertainty about future institutional behavior. If the Mint can double prices with 48 hours notice, what prevents future disruptions? This uncertainty tax affects all transactions going forward, as buyers must now factor institutional unpredictability into their decision frameworks. Establishing a monitoring framework for future developments requires tracking several key indicators. Watch for implementation of dynamic pricing grids that adjust automatically with spot prices. This would signal permanent operational methodology change. Monitor product availability patterns. Sustained scarcity suggests supply constraint beyond mere production scheduling. Track premium levels at private dealers relative to mint pricing. Widening spreads indicate the institution has priced itself out of competitive positioning. Observe international mint behavior. Coordinated pricing increases across multiple sovereign entities would confirm systemic pressure rather than isolated American issues. The strategic perspective for serious market participants is clear. The U.S. Mint episode demonstrates that physical precious metals markets operate under different supply dynamics than paper contract trading suggests. Sovereign institutions with production capacity, distribution infrastructure, and government backing are signaling through price and availability that delivering actual metal carries challenges not reflected in commodity exchange liquidity. Those building positions in physical precious metals must now navigate a market where even the most established institutional sources exhibit volatility in pricing, availability, and operational predictability. This development will not be the last disruption as precious metals markets continue adjusting to new supply-demand realities. The framework for understanding institutional responses has been established. Price discipline, strategic timing, channel diversification, and realistic premium expectations now constitute essential elements of effective precious metals acquisition strategy in an environment where even sovereign mints demonstrate operational stress under market pressure.